Good evening, everybody. Good afternoon, wherever you're watching from. Hope you all are well. Hope that this day, this week has started off good for you. We will be starting from the top, and allow me to just share my screen quickly. Okay, so we understand that there might be some new people in the program. So therefore, we will just run back everything that we've done before. We will run it back. So allow me to start from the top. Okay, so this is going to be our introductory video into Forex. If you have followed me for a while in this program, then this would be a nice starting point for you to see basically not only what Forex is, but how it is that I trade in the markets. Okay, so without any further ado, I'm going to start this session, and we will continue from here with all the strategy stuff that I have taught. Okay, so what is Forex? You know, for anybody that's coming into this field that is not sure, you find yourself wanting to get a funded account, but you want to make sure that you have everything down, I suggest that you get yourself a pen and a book, you know, a book dedicated only to Forex education. And we basically run from there. You fill that book up with all the knowledge that you will receive in this program. Okay. And then you can basically trade based on that knowledge that you have received. So what is Forex? Forex, i.e. FX, refers to the global electronic marketplace for trading international currencies and currency derivatives. Okay, it has no physical location. Okay, so there's no central physical location, yet Forex is the largest, most liquid market in the world by trading volume. Okay, with trillions of dollars exchanging hands every single day. Most of the trading is done through banks, brokers, and financial institutions. That just goes to show that the retail trader is really very, very small compared to these other guys, to the point where we are not even included in the definition. Okay, so retail makes up about, I think, between 6 to 9%, I stand to be corrected, of the entire volume that goes on in the FX market. So the Forex market is open 24 hours a day, 5 days a week, except for holidays, especially your bank holidays or country holidays. So if your country is having a holiday that day, markets will be extremely slow for the currency pair and so forth. The Forex market is open on many holidays on which the stock markets are closed. Okay, so there's another benefit for trading Forex instead of stocks. Okay, we have more volume on the Forex side and we are open more days than on the stock side. Okay, though trading volume may be lower in those times, the market is still open. Okay, so who can trade Forex, right? Any individual who wants to learn from the financial markets, who wants to earn an income from the financial markets. So if you want to do this as a side thing, if you want this to be your main thing, anybody that is looking to earn some cash, through the foreign exchange markets is able to trade. Okay, now it has been made very accessible to a lot of people over the years. It is more easier, or let me say, it is easier to open a Forex trading account, a brokerage account, than it is to learn how to drive. Okay, it is that simple. So, any individual who wants to pursue a career as a retail Forex trader. If you want to later on go into trade for banks or institutions, if you find that you have an edge, but you do not have the capital, then obviously you will look to go into a bank or an institution if you do have the skill set. However, times have changed, and now we have things such as prop firms, where we do not need to go to a bank or an institution or anything like that to trade larger funds. You are literally able to trade larger funds the same way you've been trading your own funds, okay? And that is through prop firms like the one that you are in right now, institutional prop. Okay, so what is needed to trade Forex? What do you physically need to trade in the Forex market? First things first, you will need a device to trade on. That is either a laptop, a tablet, or a cell phone. Now, I would suggest a laptop, especially if you are starting out. A laptop is the best tool that you can use because it just allows you a lot more flexibility. You get a lot more screen real estate than compared to a cell phone, okay? A tablet is just as good as a laptop, but I would prefer you do a laptop where you can have your videos on there and everything else. Secondly, you will need an internet connection. It doesn't matter where in the world you are, okay? As long as you have an internet connection, you are able to connect and trade on the Forex market. Third thing is a brokerage account, okay? You need something to connect you to this vast market, okay? You need something to connect you to the market, and the only way to do that is through a brokerage account, okay? You need a broker to basically plug you into the markets. And once you have that, you are basically up and running, ready to go. But before that, you will need a strong mindset. The Forex market is known for breaking down individuals that do not have a strong mindset. And if you stick with me throughout this course, I promise you will have a strong mindset because I teach psychology, trading psychology, way different to anyone else out there, okay? You will not find the information that I give anywhere else. Make sure that you stick around for that. Number 5, you will need a strategy that will give you an edge in the market to make money, okay? So those are the few things that you will need in order to trade the Forex market. Oh, sorry, and funds. Lastly, you will need funds, okay? Nice thing for you, you are already in this prop firm. You can basically have access to much bigger funds than you would able to do on your own. So it is good that you are in a prop firm where you can basically have access to those funds and you are able to trade bigger lots and make a lot more money than what you could on a measly $50 account or $100 account, okay? You're basically buying your way up to basically earning way more than you would if you had just tried to do this on your own or with your own funds. So we're going to get into some Forex terminology. And, you know, as long as you have this foundation down and you understand certain things, then it will make it a lot easier for you going forward. So first things first, currency pairs. Okay, what are they and how do we look at them, basically? So for each currency pair, there will be 2, okay? Sorry, always 2. And you will always have a base currency and a quote currency. Okay, so the first currency of the 2 displayed on the quote board is known as the base currency, while the second is known as the quote or counter currency. Okay, in simple terms, the base currency is the basis for the trade. Okay, so whenever you get onto a chart, the first currency you see, that is the underlying currency of that entire chart. Okay, so if the market is going up, that means that the base currency is gaining strength. If the market is going down, that means that the base currency is losing strength. Okay, so if you are buying Euro USD, you are buying the base, which is the euro, okay? And you are selling the quote at the same time, okay? And if you are selling Euro USD, you are selling euros and you are buying dollars, okay? Hope that makes sense. When the market goes up and you are buying, right? You are buying the base currency and at the same time you are selling the quote currency, okay? Likewise in reverse. Whether you are buying or selling a currency pair, right? Sorry, whether you are buying or selling a currency pair, the execution is always based on the first currency. For example, if you wanted to buy Euro USD, the exchange rate will tell you how much of the quote currency, which is USD, can buy one base currency. Okay. Next, we have pip. What is a pip? Okay, point in percentage, percentage in point, right? The pip is the minimum unit of movement of a currency. Okay, the minimum recorded movement of a currency is known as the pip. It symbolizes 0.001 variation in the fourth decimal place. Okay, so the fourth decimal place, you will see there's 3 zeros in front of the 1. That is the fourth decimal place. Okay, in 4 decimal place currency pairs, and then a 0.01 increase or decrease in the 2 decimal place, like JPY pairs. I hope this is making some sense. It's not too important, but it's good to know information, okay? In this way, assuming that the previous trade, okay, is, for example, 1.2750 on the Euro USD, and it rises to 1.2799, okay, then there will be a difference of 49 pips, okay? A currency's price moves usually, a currency's price moves are usually measured by the number of pips. Every pip a currency will move will equal a specific amount of profit or loss in real USD on every single trade. Okay, this information is not very important, but it is good to know information, especially if you are speaking to someone else. Take a screenshot of this if you must, read it on your own, understand it, and basically just apply it to your knowledge. Okay, then we have the bid and the ask. Okay, any bank or broker on the currency market acts as both a buyer and a seller simultaneously at the same time. The bank is ready to buy any currency from you, but it will buy it cheaper, okay, and is willing to sell more expensive, okay? For example, if you go to an exchange bureau, you will see that they will be that they will buy any currency from you at a cheaper price than what they will sell it for. Okay, the bid price is the price that the bank is the price that the bank buys at, and the ask is the price that the bank sells at. Okay, so in Forex, right, you want to buy a currency pair, you will get the ask price, okay? If you want to buy, that means they are selling it to you, you will be buying it at the ask price, okay? And if you want to sell, you will get the bid price, basically, okay? So there's always that amount difference. There's always going to be a slight difference, and that is their commission. Okay, if the price is what you see there on the screen and you want to buy, it will be lower than what they would sell it at. Okay, sorry, then that they would basically buy for you. I'm sure you understand what I'm saying. Okay, but the difference, okay, so in inverted commas over there, we can see the bid is always less than the ask. Okay, the bid is always less than the ask. So you are always buying more expensive, and when you sell, you are always getting the least amount. Okay. So the difference between the bid and the ask is called the spread. Okay. Now the spread is their commission that they make. When they sell it to you more expensive, it's because they are making a commission on top of that. When they buy it back from you, but cheaper, they are making a commission on that as well. Okay. Then we have the swap, which is also called overnight or rollover interest, is the fee that is charged by the bank at the end of the 24-hour trading day on open positions, is calculated according to the respective interest rates of the currencies involved. Okay, so you're basically just paying for keeping your trade open. Okay. Next, we have buy long or sell short. Okay, the whole ideology behind Forex is to sell high and buy low. Many newbies often pose the question of what it is that they are actually selling if they do not actually own anything. Well, when you sell a certain currency pair, you are buying the quote currency, which is the second one, okay, and you are selling the base, okay, which is the first currency, as previously mentioned. When it comes to stocks or commodities, however, the idea basically, the basic idea surrounds the lending of such a stock or commodity and buying it back at a later time in order to close the transaction. Okay, there is no physical delivery. Okay, so the Forex market is open 5 days a week, 24 hours a day. Okay, there is a slight maybe 30 minutes, almost 30 minutes, 45 minutes where the market is completely dead, but for the most part it is still active. There's just no trading activity around those times. Okay, so before looking at the best times to trade, it is important to look first look what a 24-hour day in the market looks like. Okay, the market can be broken up into 4 major trading sessions. These are Sydney, Tokyo, London, and the New York session. The best times, if you ever wondered when is the best time to actually trade any specific currency pair, the best time to trade a specific currency pair will be in their respective sessions. Okay, so if you want to know when's the best time to trade Euro USD, you will be trading Euro USD in both the London session, okay, because the Euro is from that side of the world, and the New York session, okay, because USD is from that side of the world. Okay, likewise, USD JPY, you will be trading that pair in the New York session and the Asian session. That would be the best times to trade USD JPY, is both the New York and Asian. And for the Euro USD, it would be London and New York. Okay, now we move on to market orders. Okay, what are market orders? So in order for you to place a trade, you have to get into the market. Okay, so how do we get into the market? First way is market or instant execution. Okay, this is when you click a button and you are either placed in a buy or sell trade. Okay, just by a click of a button, you will be in your trade. So market execution means instantly, right now, as soon as I press this button, I will be filled in my position, okay? So you can either sell by market or buy by market, which means the same thing, sell or buy, one of the two. Then we have what's known as limit orders, okay? So let's start off with a buy limit, okay? The buy limit must be set below current price. So it looks almost like this, okay? But you will be putting in the, let me just drop this so that I can use my cursor. You will be putting in the price that you want, okay? You will be physically putting in the price. There will be another section over here where you will be typing in the price that you want. And just know that the price that you select must be lower than the current price. So if this is where the market is currently, a buy limit will have to go below, okay? So if we go back here, we can see it's 0.96652. So it needs to be about 10 pips below that in order for you to place a buy limit, okay? So let's say it is 0.96550, okay? 96550, okay? That is where you are going to place the limit order. So what you expect to happen in that case is the market to come down, okay, as it's here. So this is where it is at current market price. You expect it to come down into that price. Once it comes into that price with both the bid and the ask lines, okay, as it comes down in there, it will then open a buy position for you. And then obviously when the market continues to go up, you will be making money on your buy position. And if it goes down, you will be losing money on your buy position. Likewise with the sell limit, okay? So on the sell limit over here, that is where the current price is. The only way that a sell limit can be placed is if it is above the current market price. Here we had to be below the current market price in order to place it. So when you are typing in your figures, the figures must be below where the market currently is. Likewise over here, it has to be above where the market currently is. So when you are typing in those digits, you know, for the price that you want, it has to be above where current price is, okay? So must be set above current market price. Once the market reaches the limit order, a sell position will be opened. So as the market goes up, when it reaches there and it crosses over your position with both the bid and the ask lines, then your order will be opened as a sell. And if the market turns around, you will be making money on that position. If it continues to go up, you will be losing money on that sell position. Hope that makes sense. Pardon. Okay, then we have stop orders, okay? So a buy stop, okay? This basically, what you are looking to do with this type of order is if the market is currently here, but you only want to get in at a higher price, then what you will do is you will place a buy stop order, okay? Now, a buy stop order must be set above current market price. So if the blue line is where the market currently is, you need to place your order, your buy stop order above it, okay? So if here it is 1900, there it needs to be 1950, okay? That's where you are allowed to place your order. Okay, then once the market reaches the stop order, a buy position will be opened. So as the market is busy playing around, fluctuating, you will not be opened in that position. Even if the market turns around, your buy will not be opened if price doesn't reach it. However, if price does reach it and continues to go up, you will be making money on that trade, on this buy position. If the market then decides to turn around, you will then be losing money on that buy position, but the trade will be opened as a buy. Okay. Likewise, on the sell side, if you do not want to get in where current market price is, and you want to get in at a much later price as the market is moving down, then you will be looking to open a sell stop position. Okay. Now, a sell stop basically means that once price gets here, it must open me up for a sell. And as it continues going down, I will be making money. If it goes back up, I will be losing money. Okay. So the sell stop must be set below current market price. Okay. So if that's current market price, it must be set below it. So if current market price is sitting at 1,900, then here it needs to be 1,890, okay? And that's where you can place that order. It needs to be below. So as price comes, it will trigger you in for the sell and continue, okay? Hope that makes sense. Now, how do we exit? Once we have our trade and we are either winning or we are losing, if we are either making money or losing money, we need a way to get out, okay? So there is a way that you can just quickly close the trade, okay? You can close it for either a profit or a loss. You will see it on your terminal window, all right? Or if you want to set a specific level or target that you believe the market is going to go to, or you want to save your account and you don't want price to go any further, then you will use one of these two. Okay. So a take profit, right, also known as a TP, in Forex, the take profit is a price point which is defined by the trader. So you choose the take profit, okay, as to where they wish to be automatically taken out of the trade in profit. So once you are in profit, this order that you will be placing, which is called a take profit, right, is going to close your trade. So if the market turns around, you will not lose the money that you already made or whatever the case is, right? It will basically close that trade for you and bank all your money, okay? Automatically taken out of the trade in profit once price reaches a specific level. It is an order which is used by currency traders to specify the exact rate or number of pips where the trader wants to take profit, okay? The take profit is always displayed within the order box on your trading platform, right? In the order box over there. And should be, what was I trying to say? Okay. Oh, and should be thought out way before entering the trade. Sorry, this confused me there for a second. Let me actually correct that quickly. Okay, and should be thought out. Okay, sorry about that. Okay, so the take profit is always displayed within the order box and should be thought out way before entering the trade. So you need to know where you are going to exit when you have your money secured in the trade. When the trade is now in profit, you already need to know where is it that I am looking to get out of this position once it is a winner. So as you place your order to get into the trade, you should already be placing your order to get out of the trade, okay? Both getting out in profit and in loss, okay? I'm going to show you that in a second. Okay, so for example, you execute a buy trade on Euro USD at 1.3884 and your target is 1.3930, which is 46 pips, right? that is where you will place your TP at this price. Your take profit will go to this price, and once it gets there, it will close the trade and it will bank your money, basically. Okay, then the stop loss, okay? This is so that you do not lose any more money if the market goes against you. Okay, and so the stop loss is probably the most important aspect to understand when trading Forex. More important than the take profit. Okay, a stop loss is designed to limit a trader's loss on a position and is both used for long and short positions. Just like the TP, you can set a TP for your sells and your buys. Okay, a stop loss order takes the emotion out of trading decisions and can be especially handy, and can be handy when one is on a vacation or cannot watch his or her position. Okay, so it's good when you need to step away from the markets, when you need to step away from your phone for a while. You can place a stop loss because you never know what the market is going to do. Many people think they know, and that is how they lose money. You always just prepare yourself for whichever outcome. Okay, always just make sure that you are prepared for whatever happens. Okay, that will be a wrap for session 1. We are done right now. I hope you guys enjoyed that one. That is literally just a quick run through on what we need to know about the fundamentals, the basics, like the foundation of trading. That is all we need to know when it comes to the foundation of trading. Anything more than that, I feel like you will just be wasting your time. This concept is quite easy to grasp. Trading in on its own is easy to understand, but difficult to apply. So the better you understand it, the better it would be for you to apply it in a real world scenario. Okay, but it doesn't make it any easier, because theory and practical, when it comes to trading, are two very, very, very different things. And you need to make sure that you have a solid mindset. I would suggest that you please, please, please get a notebook, write down all your notes, and make sure that you have everything down. Write down whatever it is that you learn. Write down your findings when you backtest, what you found, what works, what doesn't work. Refine the way that you see the market. Make it so easy for you to understand that if you just open a chart, then you automatically know that this is a bullish market or a bearish market. Okay, that is how you need it to be. So with that being said, guys, I hope you enjoyed this one. I will catch you guys on Thursday for our next session. God bless. Goodbye.